Hey everyone, it's Passive Income Journey 777 here, and welcome back to the channel. Today, we're diving into a topic that's absolutely crucial for anyone looking to achieve financial freedom, the different types of assets that can help you get there. Because let's face it, working a 9 to 5 for the rest of your life is not exactly a dream, right? We all want the freedom to live life on our own terms, to pursue our passions, and to not be chained to a desk. That's where financial freedom comes in, and that's exactly what we're going to be talking about today. We're going to break down 8 different asset classes that can help you build wealth, generate passive income, and ultimately achieve the financial independence you deserve. We'll be covering everything from real estate to stocks, bonds to businesses, and even intellectual property. Whether you're just starting out on your financial journey or you're already a seasoned investor, there's something in this video for everyone. So buckle up, grab a notebook, and let's get started. First up, we have real estate, one of the most popular and time-tested ways to build wealth. And for good reason. Real estate can provide you with both passive income and long-term appreciation. Think about it. People will always need a place to live, right? That's where rental properties come in. By owning rental properties, you can collect steady monthly rent checks from tenants, creating a consistent stream of passive income. And the best part is, as inflation rises, so does your rent, essentially giving you a raise every year. But it's not just about cash flow. Over the long term, real estate tends to appreciate in value, meaning your investment grows over time. Plus, there are significant tax advantages to owning real estate that can save you a ton of money come tax season. Of course, like any investment, real estate comes with its own set of risks and challenges. You have to deal with tenants, property maintenance, and potential vacancies. But with the right knowledge and strategies, real estate can be an incredibly powerful tool for building long-term wealth and achieving financial freedom. Now you might be thinking, Graham, I don't want to be a landlord, and that's totally fine. There are other ways to invest in real estate without dealing with the hassles of being a landlord. One option is REITs, or real estate investment trusts. REITs are companies that own and operate income-producing real estate, like shopping malls, apartments, or office buildings. You can invest in REITs just like you would with stocks, and they can provide you with dividends and potential long-term growth. Another option is real estate crowdfunding, where you can pool your money with other investors to invest in large-scale real estate projects. This allows you to get started with smaller amounts of capital and diversify your portfolio across different properties and locations. So, even if you don't want to be a landlord, there are still plenty of ways to tap into the power of real estate and build wealth. Next up, let's talk about stocks. Simply put, stocks represent ownership in a company. When you buy a stock, you're essentially buying a tiny piece of that business. Now, the stock market can seem intimidating at first, but it's actually a lot simpler than you might think. When you invest in stocks, you have the potential to make money in 2 main ways: dividends and capital gains. Dividends are like little bonuses that companies pay out to their shareholders, usually on a quarterly basis. These dividend payments can provide you with a steady stream of passive income, just like rent from a rental property. And the best part is, many companies increase their dividends over time, which means your passive income stream can actually grow year after year. Capital gains, on the other hand, come from the increase in the stock's price. If you buy a stock at $50 and sell it later for $100, you've just made a 100% return on your investment. That's the power of compounding in action. Now, I know what you're thinking. Investing in the stock market is risky. And you're right, there's always a level of risk involved with any investment. But here's the thing. By investing for the long term and diversifying your portfolio, you can significantly reduce your risk and increase your chances of success. Don't try to time the market or chase after the latest hot stock tip. Instead, focus on building a well-diversified portfolio of quality companies with a proven track record of success. Think about companies that you know and love, companies that make products or services you use every day. Remember, investing in the stock market is a marathon, not a sprint. By staying patient, staying consistent, and investing for the long haul, you can harness the power of the stock market to build significant wealth over time. All right, so you've heard about stocks, maybe dabbled in real estate, but what about bonds? Now, I know what you're thinking. Bonds? Sounds boring. But trust me, bonds are like that reliable friend you know you can always count on. They offer something incredibly valuable: stability. A bond is essentially a loan you give to a company or the government. You lend them money, and they pay you back with interest. Bonds are generally considered less risky than stocks. When the stock market is going crazy, investors flock to the stability of bonds. Now, just like there are different flavors of ice cream, there are different types of bonds out there, each with its own unique characteristics. You've got your government bonds, considered the safest type since they're backed by, well, the government. Then there are corporate bonds issued by companies. These usually offer higher interest rates than government bonds, but they also come with slightly more risk. After all, a company can go bankrupt, whereas the government, well, it's a bit more resilient. And then you've got municipal bonds issued by states, cities, or counties to fund public projects. These can be particularly attractive because the interest income is often tax-free at the federal level, and sometimes even at the state and local levels. Talk about a sweet deal. The key here is to do your research and figure out which type of bond aligns best with your risk tolerance and investment goals. Remember, diversification is key. Don't put all your eggs in one basket, especially when it comes to something as important as your financial future. Now let's talk about mutual funds. If you're looking for a way to invest in the stock market without having to pick individual stocks yourself, mutual funds are your new best friend. Think of it like a basket of stocks, bonds, or other assets all bundled together. Instead of buying shares in one company, you're buying into a fund that owns shares in dozens, even hundreds of different companies. This instant diversification is a huge advantage, especially for beginner investors. It's like having a team of expert stock pickers working for you, spreading your risk across various industries and asset classes. Now, each mutual fund has a specific investment objective, whether it's focusing on growth stocks, value stocks, or maybe even a specific sector like technology or healthcare. When you invest in a mutual fund, you're essentially pooling your money with other investors who have similar goals. And here's the best part: mutual funds are managed by professional fund managers. These financial wizards research and analyze the market, making investment decisions on your behalf. They're constantly buying and selling assets within the fund, aiming to maximize returns for the investors. One of the biggest advantages of mutual funds is that they offer a relatively easy and affordable way to diversify your portfolio. Even with a small amount of money, you can gain exposure to a wide range of assets, which can help reduce your overall risk. Another major plus is the professional management aspect. Instead of spending hours researching companies and analyzing market trends, you can rely on the expertise of a fund manager. They do the heavy lifting, freeing up your time and mental energy to focus on other important things in life. But of course, like any investment, mutual funds aren't without their drawbacks. One thing to be aware of is the fees associated with mutual funds. These fees can vary depending on the fund and the company managing it, so it's crucial to do your homework and compare costs before investing. Another potential downside is that your returns are tied to the performance of the overall fund. Even if the market is doing well, a poorly managed fund might not see the same level of growth. That's why it's essential to research the fund manager's track record and investment philosophy before entrusting them with your hard-earned money. Now, if you're looking for a truly passive investment strategy, index funds are the way to go. Imagine a fund that simply mirrors the performance of a specific market index, like the S&P 500 or the Dow Jones Industrial Average. That's essentially what an index fund does. Instead of trying to beat the market, index funds aim to match it. They track a specific market index, holding the same securities in the same proportions. This passive approach eliminates the need for a fund manager to actively pick stocks, which keeps costs incredibly low. And when I say low costs, I mean it. Index funds typically have significantly lower expense ratios compared to actively managed mutual funds. This might not seem like a big deal, but those small percentage points can make a huge difference in your long-term returns. Plus, since index funds aren't trying to beat the market, they're not constantly buying and selling securities. This means you're less likely to get hit with capital gains taxes, which can eat into your profits. It's like a double whammy of savings. Now you might be thinking, if index funds just track the market, how can they outperform other investments? Well, here's the thing. Over the long term, the stock market has historically trended upwards. It might have its ups and downs, but over time, it tends to grow. And since index funds are designed to match the market's performance, they're essentially capturing that long-term growth potential. Plus, because they have such low costs, more of your money is working for you, compounding over time. This makes index funds an incredibly powerful tool for building wealth over the long haul, especially for things like retirement. Think of it like a snowball effect. The earlier you start investing in index funds, the more time your money has to grow and compound. Of course, index funds aren't a get-rich-quick scheme. They require patience and a long-term perspective. But if you're willing to stay the course, index funds can be an incredibly effective way to grow your wealth and achieve your financial goals. All right, let's dive into the world of REITs, or real estate investment trusts. Imagine investing in massive real estate projects without needing millions or dealing with tenants. That's the beauty of REITs. They own and operate income-producing real estate. Think shopping malls, apartments, office spaces, generating steady cash flow. REITs pool money from investors to buy and manage properties. It's like a team effort, owning a piece of a skyscraper. REITs distribute a significant portion of their income as dividends, enjoy a steady stream of passive income. Plus, REITs are traded on major stock exchanges. This makes them super liquid, easy to buy and sell. Now, just like any investment, REITs come with their own set of pros and cons. One of the biggest advantages is diversification. Instead of putting all your eggs in one basket, like buying a single rental property, you can spread your risk across a whole bunch of different properties through a REIT. This can be a much safer approach, especially for beginner investors. Another great thing about REITs is that they offer a fantastic way to diversify your portfolio beyond traditional stocks and bonds. Remember, real estate often moves independently of the stock market, which can help cushion your portfolio during those inevitable market downturns. However, it's important to remember that REITs are still investments, and investments come with risks. The value of REITs can fluctuate depending on factors like interest rates and the overall health of the real estate market. So, before you jump headfirst into the world of REITs, it's essential to do your research, understand the risks involved, and consider consulting with a financial advisor to see if they align with your overall investment goals. Remember, investing is a marathon, not a sprint, and making informed decisions is key to building long-term wealth. Now let's talk about businesses. Owning a business can be one of the most rewarding, but also one of the most challenging paths to financial freedom, from online stores to consulting services to software companies. Your potential for income is tied to your effort and success. You can create something bigger than yourself, generating income even when not actively working. Leverage is key to building real wealth. Starting and running a business takes hard work and dedication, but the payoff can be huge. Look at Elon Musk, Oprah Winfrey, and Jeff Bezos. They built their fortunes by scaling successful businesses. Find something you're passionate about. Building a successful business takes time, but it's incredibly rewarding. Not everyone is cut out to be an entrepreneur, and that's okay. You can still benefit from business growth without starting your own. One option is to invest in publicly traded companies through the stock market. Buying stock means owning a small piece of a business. As the company grows, the value of your stock should increase, and if the company pays dividends, you'll receive regular payments. Pretty cool, right? Another option is to invest in private companies. This can be riskier but offers higher returns. Platforms like AngelList or Fundrise connect investors with startups. Do your research and diversify your investments. Let's talk about intellectual property. It might seem less tangible, but it can generate passive income and build long-term wealth. So, what is intellectual property? It's creations of the mind with commercial value. This includes patents, trademarks, copyrights, and trade secrets. You might think it doesn't apply to you, but it does. Have you ever written a viral blog post or created a catchy jingle? Guess what? You've created intellectual property. It can generate passive income for years. Now that's what I call passive income. actually make money from intellectual property. There are a few ways to monetize your creations. One option is to license your intellectual property. This means giving permission to use your creation for a fee or royalties. For example, license a patent to a manufacturing company. Generate passive income without handling production. Another option is to sell your intellectual property outright. This is good for a lump sum of cash. For example, sell a hit song's copyright for a one-time payment. Remember, selling means giving up future rights. And there you have it, the 8 types of assets that can lead you to financial freedom. Remember, building wealth is a marathon, not a sprint. It takes time, dedication, and a willingness to learn and adapt. But by investing in these asset classes, you can set yourself up for a brighter financial future. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss an update. Thanks for watching, and I'll see you in the next one.